One second. I'm just starting the recording. Yeah, we've started the recording. So just wrapping up on the previous class, we were continuing our discussion of the various methods for solving the various decision problems. And then we had one question from Siddharth on volume. And so I gave you a discussion of unbalanced volume as a volume oscillator versus price, and that's also an oscillator in general, okay? So the point to note here is that these discussions, although I disband the class because I don't want to keep you guys beyond the scheduled time, but whatever is there, since the videos are being shared with you, whatever is there on the video, so Siddharth asks a question, and in answer to that, as part of the answer to that question, I discussed topics like this: unbalanced volume, how to use it against price as a oscillator technique. So these kind of things, these are all considered to be part of your syllabus. Okay, so it is expected that you're going to watch the videos. If you did not stay back, which you're not expected to, which you're not required to, and then but you have to watch the videos to make sure that you have absorbed what the answer to the question is. Okay, so I've added some notes as well. So this is one of the techniques in technical analysis. Mean reversion traders can use these techniques. So these are basically divergence indicators. You can have them as bullish or bearish. And the general term that you want to learn is oscillator. So please make sure you go to your, go and read the books by Kaufman on technical analysis. And also you can use this, particular link I've given you at the top and in your notes file as well. All right, so these so here you use this. Don't go and learn just go and search on anywhere on the web. Use the links that I'm giving you, or otherwise you ask me. All right, so this is one thing that I wanted to make a note on, which is here in the class the previous day. So we went into DP 6.2 solutions. That is how to set the stop, and we did the stop logic for momentum traders, and we did it from the long side. We'll just quickly continue from there today. Yes, Sachin, what is your question?
Nothing, sir. I understand, sir.
Sorry, I thought you said you had.
Yes, sir.
I thought you said you had a question.
Sir, it's clear, sir. I just understand the question, answer.
Okay, fine. All right. Okay, so we'll continue then with the from the previous session. We bring the chart into play. All right, so this is Aussie yen, actually, nothing to do with your equity tickers, but you have to get used to looking at all kinds of markets. You can play around with different markets. And we will be discussing, when we get into the discussion of position sizing, we will be mainly looking at currency markets, because that'll allow us to look at some general principles and multiple scenarios. So anyway, so this will come up. Aussie yen will come up as a part of the discussion later on DP7. Right now, let's go back to what we have here, which is we are talking about the solutions. Where we were the other day was DP 6.2 solutions, and we looked at FCX, right? And we looked at, this is our 1 year, and we looked at 3 months, and we had the discussion on where the stop would be for a momentum trader, because both the trends, the short-term and long-term trends are up. The momentum trader would want to go long. There is a green signal to go long. And where would the stop be for the long position? And the answer is the stop would be over here, the highest low from which a new high is made. Okay, and the low beyond which, if this low is broken, then the pattern of higher lows is broken and the trend is neutralized, which means the long position that you put on earlier, thinking that the trend is going to continue, that long position can no longer be justified, because the trend is obviously not going to continue now, has no guarantee of continuing because it has been neutralized. So therefore, another way to see this, of course, is also to go back to your, if we go back to your DP4, see what the DP4 is. Okay, I think we have it here in our typical simple trading system, where we give you the rules for solving. Or another reason you know that this has to be now liquidated beyond this point, because if you look at your DP4, this I've tidied up the notes a little bit, mainly focusing on these three, because initially we are building a minimalistic trading system. So if you look at your DP4 system, momentum philosophy, the conditions for clear buy-sell solution, that means to be able to decide clearly that I'm going to be a buyer or I'm going to be a seller, to have clarity on that decision. You need the trend on both to be the same, and the trends have to be intact. That means they cannot be neutralized. So the moment that this trend, the market falls below this and the trend uptrend here is neutralized, immediately one of these, this is another way of looking at it, one of these conditions is now violated. Number two, the trend is no longer intact. Okay, so which means the decision that you took earlier to go long, now that decision can't be justified anymore because the conditions are not in place anymore. One of the conditions is violated. So there's another reason why this has to go now. As soon as the price falls below this, you need to exit your position. That's why the stop needs to be here. Okay, so let's quickly look at, so this is what we did the last time. Okay, and just for the sake of comprehensive treatment in the class, and so that you can refer to it later, I am just also going to do the reverse of this. We're going to do the momentum philosophy. We're going to solve 6.2 for the momentum philosophy from the long side. Okay, just from the short side. Okay, in this case, when you go short, what happens? So let's look at this. I think we have it here maybe. Yeah. So let's look at ExxonMobil for momentum trader. This is basically, now we are discussing this under your simple trading system. We are discussing the stop logic, which is basically how to answer this question, this decision problem. Where should I set, if I start making losses on my position, at which price do I exit, or at what point on the chart do I exit my loss-making position? Okay, so this is a stop logic essentially, and so the stop logic, we look at it from momentum and mean reversion, both sides. So under momentum, we've looked at, we already gave you the example FCX. For the short side momentum, let's look at XOM. XOM is, what does XOM stand for? What's the company? ExxonMobil. Okay, make sure you're very familiar with these. Of course, this is not, I don't think, this is also part of your ticker, right? So, make sure you're familiar with the names of the companies. One of the biggest integrated oil majors, these are called integrated oil majors. That means they go all the way from drilling the oil in the oil fields down to having, owning gas stations, or what we call petrol pumps in India. So they go all the way up the chain, okay, from drilling for oil in the ocean or somewhere else, and then all the way down to, that's why they're called integrated oil majors. So if you remember your vertical integration, etc., in your M&A classes, vertical integration. So these are, backward integration, forward integration, and all those terms. These are called integrated oil majors. So ExxonMobil, unfortunately, not doing too well for a long time. Now, anyway, so you see this trend here. This is our 3-month trend. Okay, so we see there's a trend here, a 3-month trend. Okay. Now, so in general, I'm not going to look at chat messages. Okay, if you have anything urgent, please tell me. Okay, orally, so then I don't have to waste my time looking at chat messages. But those messages where you're talking about, it got delayed or things like that, just leave it in the chat, and I'll look at it later. And during the class, you ask me orally if there is any question or any other kind of emergency, operational kind of emergency. Okay, so ExxonMobil, we are going to look at the what are we solving? We are solving the 6.2 for the momentum philosophy. This is where we are, 6.2 for the momentum philosophy. Now we are looking at for short positions, okay? So now when you look up ExxonMobil, this is your 3-month chart, and you see there's a clear downtrend, okay? And so you want to go short, but you have to check, because remember you have the other problem. You have the second filter, the first filter to check, the high level filter. You need to look at the 1-year chart, and you can see there's no real kind of overwhelming uptrend clearly, and there is obviously a downtrend, okay? The high is made earlier than the low, and there is a downtrend, and there was a little bit of a recovery, but then again the market has started to decline, so that is pretty much very close to the 1-year lows, okay, pretty close. And then you can see on this recovery that happened, it basically had these highs and lows, and even this actually is being destroyed. Even this low has now been broken. So even if there was a recovery, now the backbone of this recovery has been broken, because the price has then subsequently declined all the way here. So you can essentially take it as a downtrend. Okay? This is the downtrend. So it matches the filter on the first level filter, which is the 1-year trend, can be said to be down quite clearly. And then when I look at the 3-month trend, I see that it's also down. So I'm now able to go short. Okay. So I'm able to go short now. Right. Now, when I'm able to go short, now obviously as far as this tells me clearly that, look, if the 1-year trend is down and the 3-month trend is down, these are our, the 1-year and 3-month is our long-term and short-term periods that we are using. You can use any other kind of period. Okay, and so this tells me straight away as a momentum trader that my bias is going to be on the short side. I want to go short, and then the question is whether I go short at the current market price, or at a price more favorable than the current market price, or at a price less favorable than the current market by using a stop order. And that, as we said, for the purposes of the discussion right now, minimalistic trading system, we are going to solve that DP. We are going to solve it always by choosing to go short, long or short at the market. So DP5 is decided, we go short at the market. Now this leads us to the question of DP 6.2, which is where is the stop going to be, which is the current focus of our discussion. Where is the stop going to be? Okay. So here you can see that our stop, let's ask somebody and check. Shaurya, can you tell us, if I'll zoom in a little bit. So here's XOM. We are going short. We are a momentum trader. We're going short. We're going short at the market price. Now the question is, should my stop be? Let me zoom in so that you can read a little better. Okay, maybe, yeah, something. Yeah, you can see this. Yeah. So approximately where should my stop be, Shaurya, if I go short at the market? Based on, okay, now let me highlight the trends. Let me highlight the patterns for you. Otherwise, you don't know what degree of trend to look at. Okay, so the highs, the degree of zoom, the minimum, the maximum zoom in. Okay, understand what I'm saying? Maximum zoom in. You don't zoom in more than this. High,
Yeah.
high, high, high,
Yes, sir.
high.
Yes,
Low,
sir.
low, low, and so far we don't know where exactly the low is, for somewhere here, which means that I'm not looking at this high. Okay, I'm not looking at this high. I said this high, and this high, and this and this. That's my maximum zoom in level, which means that you don't look further inside. Okay, although it may be visible to you as a human being, you naturally see all different levels of zoom simultaneously, but you have to exercise control and make sure that at a point of time you lock into only one maximum zoom in level. So having explained all this now, Shaurya, approximately what price level should our stop be at?
Stock be at, or what? What should be the point where we should it is not going anymore, and we should just trade our stocks while booking losses.
Yeah, I mean, you have all the language that you have used, that's basically what we call the stop, okay? Because when we, in trading parlance, okay, when we go short, if you're discussing this with a trader, if you're discussing your view with the trader, and you say that, okay, I looked at ExxonMobil, I'm a momentum trader, and both the short-term, long-term patterns are pointing down. So I can immediately go short. And my philosophy is always to the entry price decision problem. I don't even treat it as a decision problem because I always solve it by choosing to enter at the market price. When I look at ExxonMobil, straight away I know that I can go short around say 36. That's where the market is roughly, right? Around 36.
Yes,
Yeah, so I go short immediately at 36. Now the question that the other guy is going to ask you, okay, so you went short ExxonMobil at 36. Okay, now where did you put your stop? That's what he's going to ask you. Where did you put your stop? Immediately, that is understood by everyone in the market is that stop point. The stop point is the price point beyond which you will immediately exit your position. And so you went short, that means you will immediately buy back the equivalent number of shares. So let's assume you went short 1 unit, that in this case is 100 shares. So you sold 100 shares at 36. Then whatever you set as the stop level, that's the level beyond which you immediately will exit your position. So my question to you is, what is that question? Yes, Vipul, why you want to answer the question?
Yes, sir.
Okay, wait a minute. Let's give Shaurya a chance first. Yes, Shaurya, you have understood my question now?
Last part. Okay, so it is going short at around 36, right?
Yeah, we are going
So,
short at 36. My question to you is, where should our stop be? Given that I locked you into this zoom, this high, this high, this high, and this high. Now, where should your stop be? Approximately tell me the price. Yes, Shaurya?
our price should be around 38, sir.
Okay, all right, good. So you have understood the logic that it should be around 38, which means essentially what you have in mind, obviously since you can't use the cursor on this chart, what you have in mind is this high, correct?
Yes, sir.
That's like, yeah, okay, good. So the logic that you have used is that, well, I will be asking you, but I'll save you the time so that we can move on. And so the logic obviously is because I said that these are the highs you look at, high, 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 and high, okay? And this is in the case of the short position, this is the lowest high. Okay, forget the English, I'm telling you the English so that you also know the theory. The lowest high, if you remember it visually, then everyone will understand. There is no need to get confused with the English, but this is the lowest high from which a new low was made in a downtrend. And essentially, visually, it's much easier to understand. As soon as this breaks, the pattern of lower highs, okay, HT plus 1 less than HT, that pattern is broken. And so therefore the downtrend is neutralized. And once the downtrend is neutralized, you no longer have a justification for being in the short position, okay, because there is no downtrend anymore, which is intact. The downtrend is not intact, okay. So your second condition for being in the position is no longer there, and so you have to now, logically speaking, you have to exit the position, okay. So that's why your stop is here. Has everybody understood this? Anyone who is not clear about this so far, what I've explained? Everyone is clear? Okay. All right. Okay. So that's fine. So which means what we have done is we have now covered the momentum logic for both short and long, for long and short positions for momentum traders. Okay. We have covered the logic to derive the stop. Where should we, when we visually look at a chart, where should we place the stop? Okay. All right. Now let's look at this. Next one, let's look at the stop logic. This is what I told you to do as homework. Okay. Mean reversion traders, what is the stop logic? Same stop, same question basically, same question of 6.2, DP 6.2, where should my stop be? But now let's look at mean reversion traders. Okay. So let's look first at GE. We did our initial discussion of mean reversion for Procter & Gamble, but PG is not part of your ticker set, but we just remind ourselves what we looked at. If we see, I think initially we go to 6 months and then we look at 3 months. So what we were looking at is essentially this, or we can just look at it and point out on this chart. So on PG, the reason we said, of course, this is not justified by the longer term trend because the long term trend is up, but just as an example, looking at the short term trend, for a mean reversion trader, when he's here, he can't go short because the trend is intact. Okay, so if you look back at the entry rules for mean reversion, okay, can't trade against the long-term pattern, can't trade against an intact trend. Okay, so initially we just assumed that just for PG, the discussion we had was we didn't really think about the first part because it would not have been satisfied. We were looking at the second one, and we were trying to explain the second rule actually. Trying to explain the second rule, and we said essentially that because the second rule says you can't trade against an intact trend, here all these places you can't go short because the trend is still intact. The first place you can go short is when this low is broken on September 4th, and that's what we said. Okay, so the first time when the uptrend is neutralized, only then can you go short. But you also need the second condition to be, the first rule to be satisfied, which is the long-term pattern also should not be up. Okay. So therefore, in order for you to go short, if you're going short, in this case, obviously you can't actually do the PG trend. You can't go short on PG because when you look at the 1-year trend, it's very much up. Okay, so now you are thinking of looking at the short-term 3-month trend, and because you saw a break here, you want to go short. No, you can't actually, because the long-term trend is up and you can't trade against the long-term trend. So that was just as a discussion. That's our initial discussion. I'm just trying to remind you because a lot of our discussion on the mean reversion rule happened on BG. So you have to wait until the trend is neutralized. So mean reversion means you're going against the trend. You have to wait for it to be neutralized, and only then can you go short. Okay, so let's see what examples we have here. So now we're trying to do 6.2 for stop logic for mean reversion. So let's look at the long position first. Okay, so we look at GE. All right, so just go initially to 6 months, and then we go to 3 months. So when I look at 3 months for GE, I see that there was a downtrend. Okay, there is still a downtrend in the sense that the highest price, the timestamp is earlier than the timestamp on the lowest price. Okay, so according to our mechanical definition of the trend of trends, this is a downtrend. Okay, but it is not a, it is no longer a intact downtrend because multiple highs, whether you look at this zoom in level and look at these highs also, or whether you just look at this zoom in level, this has also been broken, right? So when you come to this chart as a mean reversion trader, remember a mean reversion trader always wants to go against the current trend, all right? So now what happens is you look at this, you want to go against the current trend. Now the current trend is still down, and you want to go against it. So if the current trend is down, you're going to be looking to go long. But in all these places here, here, etc. Okay, here you could not have gone long because there was no neutralization of the downtrend. Okay, the earliest neutralization, if you're looking at the slightly lower level zoom, is here. Okay, and then of course this is also taken. But even if you're looking at a high level zoom, this one is taken out here. Okay, we can look at the 6-month chart for clarity. Okay, so you can see here. Let's look at the right. So the way we would look at it is essentially this. And these are not very good examples. Now, right now, we're not getting a good combination of consistency on both the 1 month and the 3-month charts. To be able to actually get a clear signal, because the directions are mixed up. If the long term is up, then the short term is down. But anyway, so in the case of GE, what you can see is, if you look at a 6-month chart, this trend is down, and this is the first time. So you are looking at this downtrend. All right, you're looking at this downtrend here, and yeah. So the first signal that you get is over here. Let's say, okay, this breaks this particular. You're looking at a downtrend. You want to go long, but the first signal, if you ignore these zoom in levels, if you ignore these levels, all right, the first signal that you get to go long is on a break of this, because once it breaks this, then the pattern of lower highs is broken. We go out a little bit. Okay, here, this will give you a better picture actually. If you ignore the, here you would set the zoom as this one high, second high, third high, fourth high. Okay, you can even set these as 5 and 6. These seem to be almost on the similar kind of a scale of pattern, but slightly lower, of course. But you can set this also. Let's set it here so that we have more highs to look at. So let's say we have this high, this high, this high, this, and this, and this. Okay, this is our sequence of highs, and the lows are here: low, 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 and even this is lower than this. So this low and then this low. Okay, so these are our highs and lows, which define the maximum zoom in level that we are going to apply when analyzing this chart. This is a very important exercise which you must do when you look at any chart with a view to taking a decision. You must define for yourself what is the maximum zoom in level that you're using. Okay, that will help you, that will help avoid confusion. So now you see that on this chart, as a mean reversion trader, because the mean reversion trader's thinking is always to go against the current trend. The current trend is here, the current trend is down. So he obviously wants to buy because he wants to go against the current trend. But he does not get a buy signal until this is broken, okay? Because he cannot trade. Remember that the rule of mean reversion is, I'm not going to go back there because I'll have to scroll up the chart, scroll up on the page. But you remember the second rule of mean reversion trading for solving the DP for the buy-sell bias decision. The second rule is that you can't trade against an intact trend. So if you're thinking of trading, you look at this downtrend, and you want to, obviously, as a mean reversion trader, you want to trade against the downtrend, which means you want to go long. But the second rule of mean reversion says, mean reversion entries, the second rule says, not entry price, but the buy-sell decision problem rule. The second rule says you cannot trade against an intact trend. So the trend is still intact here, all these points. The first point where the trend is no longer intact is when this is broken. When this high is broken on this, around maybe on this day or something, 16th September, okay, this sharp rally. Here you can say that, okay, now this long downtrend is neutralized, okay, because we have a move up, okay. So this is the first time you get a signal to buy as a mean reversion trader. And then you have to go back, just to make sure you know the methodology, you have to go back and check the long-term trend. And here it's a little dicey because it still looks very much down. So what we can say is, just for the sake of, I would not actually do this in the real world. I would not treat this as a bullish pattern or a long-term uptrend or anything like that. But just to be, just one second. Just to be, just to be able to give you a example of where we can actually put on a trade as a mean reversion trader, I'm going to forcibly zoom into a point where I can forcibly say that there is an uptrend, okay? So in real life, of course, you must not do this. You must stick to your system. You have a 1-year rule for the long term. You stick to it. There is no convincing uptrend on the long-term pattern, okay? You can say there is a neutralized downtrend because there's 1, 2, 3. and this high is higher than this high. So there is a downtrend which has been neutralized. But according to our rules, this would not qualify as a negation of a long-term downtrend, which means this would still be seen as a long-term downtrend, which means what you want to do on the short-term pattern, which is to go long, is not going to be allowed, because the first rule of mean reversion is can't trade against the long-term trend. Okay, so just to show you the correct way to apply the method, I'm just telling you that in this case GE should not be seen as a, for this pattern, that it's not a long-term uptrend. Okay, at the most it is a neutralized long-term downtrend. But what I'm going to do in this case, because I'm desperately searching for an example where I can show you in the case of a long position for mean reversion, I'm desperately looking for a situation where I can show you that there is a long-term uptrend and then there is a short-term downtrend which gets neutralized, and that gives you the signal for the mean reversion trader to go long. So I'm trying to show you that situation. So what I'm going to do is I am going to forcibly choose my data range in such a way that I can show you a long-term uptrend in GE. Okay, so that's what I'm doing here. So understand what I'm doing here. All right, so what I'm going to do is I'm going to keep on zooming in. Yeah, now I can say that there is a long-term uptrend because the high is made lower than the low. Okay, and overall the previous price action is kind of neutral. So you can say there is an uptrend. Okay, and within this uptrend there is a fairly deep retracement. Okay, so this, let's say this is our, now I'm not going to use these time frames anymore because it will get confusing. So what I'm showing you, I'm going to show you both the time frames in one chart view. So you have to imagine it. This is a long-term uptrend. And so you see how mean reversion is used. If you're going to use mean reversion to go long, okay, you have to ensure that at least your long-term trend is up. So you have to select a picture like this where automatically you get a clear long-term uptrend. And within that long-term uptrend, you see a short-term decline. Okay, this we will treat as the short-term decline which we saw on the 3-month chart. Okay, remember when we look at 3-month charts, this is the short-term decline and this is the long-term uptrend. So we won't, you just see one line up, long-term uptrend, then a decline, short-term decline, where we can see all these highs, high, 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 here high, and this another high. So here what happens is you need a long, in order to go long as a mean reversion trader, you need a long-term uptrend. Okay, remember I'm showing you both the pictures in one chart. So you have to imagine a little bit because I don't want to lose this particular data range where I've got a long-term uptrend. So long-term uptrend, and then within that short-term downtrend. Okay, and then the downtrend gets neutralized. So you understand now how you go long as a mean reversion trader. You essentially have to make sure. So if you're going to be a mean, remember this is our trading time frame. The trading time frame is always the short-term time frame. The long-term is only a filter. Okay, it's only a filter. So all the stops, everything is set based on the short-term time frame. The short-term, that's the trading time frame. The long-term is only a filter. But still, it's important because you can't violate some of the rules. So as a mean reversion trader, if you want to go long, you look at the short-term downtrend and you wait for a neutralization of the downtrend here once this high is broken. And you say, okay, great, now I can go against. Why are you a mean reversion trader? Because you're going against the trend. Which trend are you going against? This short-term downtrend here, okay? This is what you're going against, but you don't go against the trend here, 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 anywhere. You wait until there is a neutralization of the short-term downtrend and the earliest point. So you see how long the trend lasts. It starts from about 5th of June, the downtrend in General Electric, and the earliest pattern. So already by now you have a clear downtrend because you have high, high, low, low, 2 lows, 2 highs. Downtrend, as soon as this comes, by 23rd June, the downtrend is established in GE. but you can't go against the downtrend because there is no neutralization. Keeps on going, keeps on going. And then the earliest date where you can go against the downtrend is 16th of September, when this high is broken. So the pattern of lower highs, which maintains the downtrend, is now destroyed. And so this is the first time that you can go long as a mean reversion trader. Okay, is this clear? This is your first buy signal. All right, so as a mean reversion trader, you would actually have a stop. You would actually have a stop-based entry here. So when the market is over here, etc., you would see what is the lowest high, and you would actually place a buy stop, because your market, you may not be available. You may have gone out when the market is trading. So you would keep a stop order. So when the market is declining here, etc., and you see that this is the lowest high. So at any point when the market is here, you can easily identify as a mean reversion trader what is the point at which this long-term downtrend will be neutralized, which means what is the first signal that I will get to go long? And that answer is here above this high, which seems to be, if I read out from the chart, 6.65. So as a matter of fact, when the market is here, as a mean reversion trader, you would place a buy stop order. A buy stop order at 6.66, one tick above the 6.65. So you would have a buy stop order at 6.66, okay? While you have gone out for lunch or gone out for a coffee, and the market may break this level when you're out having a coffee, but you will still get your position, because if you have a buy stop at 6.66, as soon as the market trades at 6.66, the system is going to enter a market order to buy. So that market order may not be filled at 6.66. It may end up getting filled at 6.7 or something like that. But in any case, you will go long at 6.7. Okay. Now, is everyone clear so far what I have explained? You guys have to be alert and make sure that you're following all this, okay? Because in an online class, I'm not able to see everybody. But if you're not following, you're the one who's losing out. All right. So you have to make sure you pick up what's being taught. Okay, so we are all cool. We understand everything so far. Okay, now let's ask, who should we ask? Let's ask, okay, let's ask Sonal. Now that you followed my logic so far, I placed an order at 6.66, stop order, okay? And while I was out having a coffee, the market filled my stop order. I'm a mean reversion trader, the market filled my stop order. And so now, let's say I'm long at 6.7, okay? So I'm long at 6.7, okay? 6.7, I'm long General Electric, 100 shares, okay, 1 unit. Now, Sonal will tell us, now I will make this easier for her. I will go back into the 3-month view. Okay. Or yeah, I'll go back into the 3-month view, which gives us a better picture of the, we can go out a little bit. Yeah, this is the downtrend that we are looking at. Now, so now Sonal will tell us, because remember this entire discussion is happening in what context? In the context of our discussion of how to solve the decision problem number 6.2, which is exit price with loss. Okay, exit price at a loss. That is, when I go into any kind of position, at what level will I set my exit price for a situation where I'm losing money? Okay, there are 2 types of exits: situation where you're making money and situation where you're losing money relative to the initial position. Okay. Okay, actually that should be relative to the current market, because on a stop, the discussion we had about stops and stop loss, etc. That is, if you go back to that discussion. So it should be relative to the current market. So this, we are now discussing the exit price with loss situation. Okay, so now coming back, setting the context, but that's our whole concern at the moment. Where do I set my stop? Now that I've gone long or I've gone short, where do I set my stops and long positions, stops and long and short positions? Where should I set my stop? So we did it for momentum. We're doing it for mean reversion. So we went long in GE. So now Sonal will tell us approximately where should my stop be now that I have already gone long at 6.7 through my stop order. So this is a stop order based entry. Now you can understand we haven't had the detailed discussion of DP5, but you can already see how stop orders can be used to enter positions. Okay, now Sonal will tell us now that we have gone long at 6.7, approximately what price, approximately what is the price at which I will set my stop order for my long position. I've already gone long at 6.7, but I need to place a stop to ensure that I don't have huge losses. And so approximately where will my stop loss, my stop level be? Yes, Sonal? Okay, so Sonal has fallen asleep. Okay, let's ask somebody else. Let's ask, okay, Vipul, yes, you can answer, yes.
Sir, at 6.
Okay, at 6, okay, let's ask somebody else. Let's ask Kanika. Kanika, you agree with Vipul? Or you disagree?
Sir, I think it would be between something around that.
At
Higher than 6, a little higher than 6.
higher than 6, okay. So,
So a slight higher than 6, and not much, a little higher.
no, but why? So I'll tell you what I think Vipul means by 6. Vipul is saying 6 because visually Vipul is, and that's why I use the word approximately. I think Vipul is visually focusing on this point, the lowest low made so far. Okay, am I right, Vipul?
Actually, sir, my point is above this.
Why?
The slightly above this, sir. 6 point. Sir, can you? Yes, 16 wala, sir. 16 September. The point at 6. Sir, slightly above.
Yeah, somewhere here.
Yes, sir.
Okay.
6 point. Yes, sir.
Now we are discussing the details of this. So we are really focused only on this last part of the movement. So let's zoom in so that we can have a more detailed discussion. Okay. Let's zoom in more detail and see. Okay. Now, what I'm saying, what I want to understand clearly is, now Vipul said something like, now this was the break. This was the critical break where we went long. Okay. And this is the lowest point of the series. Okay. If we look at 6 months, this is the lowest point of the series. Okay. So if we zoom in greater detail, we want to understand the thinking around the point, around this point, as to how you set the stop. Okay. This is the lowest point so far. So Vipul is saying his stop is here actually. Somewhere here, right? Not here. Am I right, Vipul? Yes?
Yes, sir.
So you're saying not here, but here.
Yes, sir.
Okay. And what is Kanika saying? Even higher than Vipul?
No, sir, I was saying about this point only. I thought it was little higher than 6 when it was, zoomed out. I thought it showed a little higher than 6.
So
Otherwise, I am saying about this point only.
okay. So you agree with Vipul basically in terms of selection of point. You are in agreement with.
Yes, sir. Yes.
Okay, okay.
Yes, sir.
Sachin, what is Sachin saying?
So can you repeat question again so I can?
So question is very simple. We are discussing the setting of stops for, both. We are discussing the whole decision problem around the setting of stops. Where should I set my stops? Where should I set my stop? Once I've entered a position, long or short, where should I set my stop? And we have come to the situation we're discussing it for 4 situations. Momentum, long and short. Mean reversion, long and short. Now, momentum discussion is already over. Now we're at the mean reversion discussion. We are discussing a case where a mean reversion trader has gone long as soon as a downtrend is neutralized at this point. So the mean reversion trader has gone long at 6.7. Now the question is, okay, now that you've gone long, where is your stop going to be? Okay, what is the point at which you exit the position with a loss? Because you have to plan that ahead of time. And so the answer to that question, Vipul is saying, both Vipul and Kanika are agreed. Now we can zoom in even more, actually a little bit, to understand what is going on. Okay, maybe we don't need that. There's no value addition from extra zoom in. So essentially, Vipul and Kanika are saying that their stop level is here, 15th September, actually 15th September, this low, visually, because you have to select it visually on the chart. The way it works is, you can't really read the exact level by looking at it visually like that. You have to visually identify, pinpoint the high, because the stops are always going to be at some high or low, okay? It is only a question of which high or low you select and what is the zoom level that you use, all right? So it's always going to be some, so visually the way it works is, first you select, okay, let's zoom in a little bit more. First, you identify visually which low or high is the stop. So let's say Kanika and Vipul have identified this low. And then what they do is, the way you use a chart is you position the cursor on that bar, in this case, that candlestick. And then you read from here. Here you get the readings, okay? So I'm positioning the thing here. The date is 15th September and as you can see, the low here is 6.02. Okay, so that's how you set your stop. And in this case, Vipul and Kanika will set the stop at 6.01 because it is one tick just below the low of this date which they have selected. Now that's what they have done visually. They have selected this low on the chart. So now, Sachin, we are asking you, what is your answer to the same question?
Yes, sir. My answer is I am going for loss at 5.992 because at 11 September, 5.87, yeah, 87 or between the 8.7 and 9.7. Because sir, if you see the 3-month chart, that is all-time low in 3 months.
Okay, all right. Okay, good.
So, yes, sir.
Yeah, I understood what you're saying. So I hope everybody else understood what Sachin is saying. The reason he's saying 5.92 is, again, the way the process works is, visually you select. Now there is a difference between what Sachin has done and what Vipul and Kanika have done. Is Sachin has selected a different low. He selected a different low from Vipul and Kanika. Vipul and Kanika zeroed in on this low, and Sachin has selected this low. Okay, so visually there is a difference in the decision. So he selects this low, positions the cursor, and the reason he says 5.92 as a stop level is because the low here is 5.93. Okay, and as he correctly pointed out, this is the lowest low in the 3-month chart. If you look at now, if we go out a little bit, okay, you can go out a little bit now. Yeah, I think this zoom is fine. Okay, so we can check with one more person. Let's ask Ketan. Ketan, who is right, Vipul and Kanika or Sachin?
Sir, I don't know.
You don't know. How is this possible? You have to. Are you doing the project? Are you doing the project? Yes, Ketan.
Yes, sir. Yes, sir, I'm doing.
Okay. So how is it possible that you don't know? Okay, let's ask Kritika. Kritika, you have a view who is correct, Sachin or Vipul and Kanika?
I'm not sure. Maybe Vipul.
Okay, so you are also siding with Vipul and Kanika. Okay, so I'll spare you.
Sir?
Yeah, yes, Mitali.
Sir, Mitali this side. Sir, can I try, like, I have a point of view.
Yeah. So first of all, English correction, you have to say, may I try? Okay, or could I try? So not can I try. Okay, so don't mind if I correct your English also. I have to check everything. For students, I have to check everything. Yeah, go ahead, Mithali. Yeah, you can give your opinion.
Sir, what I was saying is, if we take below 6, that is what Sachin said. So we can say that it's like a short term downfall. Short term downfall didn't impact the long term base. Didn't have an impact on long term. So we can say, like, if we choose the Whipple's point, then there is a chances that it will again go up.
No, actually, I'm not. You're not making much sense. Actually, I'm not able to understand clearly what you're saying. First, you tell me straight away. Very simple question. Now, I asked people the question that we went long and a break of this. We went long with a stop order at 6.7, let's say. Now the question is, now that I'm long at 6.77, where should I set my stop? That is, my entry has already happened at 6.7. It's a long position. Now, where should I set my stop to take me out of my long position in case I start losing money? Okay. Now, the answer to that question, Vipul and Kanika have given this. Okay. And Kritika is also siding with Vipul and Kanika. So they have said essentially they have chosen this low, and Sachin has chosen this low visually. Okay. Now, my question, the first question to Mithali is, who are you siding with, Sachin, or you're siding with Vipul and Kanika?
Sir, Sachin.
Okay, you're siding with Sachin. Okay. All right. So we will stop. Sachin, you still have your hand up. You have another question, or I'll continue.
No, sir. No, sir. Sorry to forget. Lower my hand.
Problem,
I'm sorry.
no problem. It's okay. No problem. Okay. So now, okay. So I'll stop the questioning at this point. So the answer is that Sachin is correct. Sachin and Mithali are correct. Okay. All right. So yes, you have a question. Sachin, you have a question. Okay. All right.
No, sir.
Okay. All right. Okay. No problem. Okay. So the answer is that Sachin and Mithali are correct. Yes, Vipul.
Sir, actually, I have a question, sir.
Yes.
Sir, if this is the basically the lowest low at 14 September, sir.
Low is here.
Hello.
Lowest low is here.
Yes, sir. I am saying that only, sir.
Okay.
Sir, if we go for this point, sir, it will be a loss for us also.
Okay, no, once again, now let me answer your, I think your question will become, the answer to your question will become clearer once I have explained why Sachin is correct. Okay, so let's understand this, and let's also understand the other day while we are on this discussion, please note this, you can come back later and play back this video or watch it yourself, that the other day Siddharth had talked about the inverted head and shoulders kind of pattern, a head and shoulders pattern. So here you see a very interesting example of an inverted head and shoulders. So I'll tell you also how to select patterns, although it's a different discussion actually. But here just I happen to notice it, so I'm pointing it out. You see that there is a decline. Okay, there's almost a kind of a clean inverted head and shoulder, very clean pattern. Okay, which is and which works also as well. Okay. You see a long downtrend. So first there must be a long downtrend. Okay, inverted head and shoulders is a bullish reversal pattern. Okay, that means it will reverse. The trend will reverse in a bullish way. Okay, that's why a bullish reversal pattern. And the opposite of this is the normal head and shoulders, which visually you imagine you flip it around to the long side, and that you can study later on. But I'm just showing you here on general lecturing. You see an inverted head and shoulders pattern, where you see a long decline. This is the left shoulder, okay? The left shoulder, this is the head, okay? And this is the right shoulder, okay? So you have this pattern forming, and this is what is called the neckline. You can see here, neckline. If you draw a neckline here, you can get a left shoulder here, you can get a head here, and you can get a right shoulder here, okay? So you have a very nice inverted head and shoulder pattern. And this is exactly a classical pattern because As soon as the neckline breaks, after forming the right shoulder, you have a sharp rally, okay, massive rally up here, okay, compared to this movement is a very big rally, okay, and that's what it is basically. It's a bullish reversal pattern, which you see towards the end of a downtrend. Okay, so this is I just happened to notice it, so I'll just talk about it. And it's an inverted head and shoulders pattern. Now coming back to the question of why Sachin and Mithali are correct and Vipul and Kanika's answer is not correct. Okay, here's how it works. So here's the logic. Very simple. Remember the general principles. Okay. You went long. Why did you go long? Because you're a mean reversion trader and you waited for your second condition to be satisfied, which is you wanted the downtrend to be neutralized and you already had a filter of a longer term uptrend. So now you're able to go long. Both the conditions are satisfied as a mean reversion trader. Now you're able to go long, all right? So now that's fine. Now you went long because now you have an expectation that the downtrend has reversed. Now it will keep on moving. Short-term downtrend has reversed and the long-term uptrend will now take over and continue to move higher. And you use your mean reversion philosophy in the trading time frame. Now the question, so what are you saying when you go long? Just like the same logic we discussed the other day in our class when Umbat was asking the question, right? Why did you go long? We understood try to understand what we can infer about your views based on your actions, your views about the trend. You're going long, which means what we can say clearly is that as far as your view of the trend is concerned, I don't need to ask you. I know, I can see that you've gone long, which means you must have a bullish view of the trend on this pattern, the short-term trend. Your view must be bullish because if you went long, and we know everybody wants to make money, so if for a long position to make money, the price has to move higher. Okay, so if the price is going to move higher, the trend has to be up. Okay, it is only an uptrend that is going to take the prices higher and higher. Okay, that is the only additional assumption that we need to make. So instead of making just first I look at you going long, I immediately know that this guy expects prices to, I don't have to ask him, what do you expect prices to do? I know since he's going long, okay, I know everybody wants to make money, so he must naturally expect that prices are going to rise. So the only additional logical step I take is that I say that prices will rise. Now let's make it even more specific and say that this guy expects an uptrend to be developing, okay? So we are making it a more specific. Instead of just saying he expects prices to rise, we say he expects there to be an uptrend, okay? So that's not a big statement to make. We're just making it a little more specific. Now, the moment we can say that, what happens? Okay, let me try and write down this logic so that, so general principle we are coming to, okay, we will use the general principle, which is the general principle is that, we can write it from the top, is that when you, I'll copy it from the top, okay. Yeah. Yes, Krish.
The Krishnanand is side.
Yeah.
Sir, if we go with Sachin, we can see Sachin has seen the 3-month chart, but if we see the 6-month chart,
yeah,
then there is also a low of pointed 5.48. Why don't we bet on 5.48 as a stop loss?
No, I have actually taken you out of that view. You're right about that, but everything depends on the view that I'm showing you, okay? So in this case, I have taken you out of that view and I have made you, because I wanted to illustrate the mean reversion principles. So I artificially restricted the data range in such a way that I could show you this view, okay? So you're right, you're absolutely right, you're not wrong in that. But at this point, we are not considering the kind of information that you just brought in, okay? You understand what I'm saying?
Yes, sir. Yes, sir.
I have artificially, so you're absolutely correct. If you use that high level zoom, that kind of level of zoom out, that means basically what you're doing is relative to what I'm showing you, you are actually zooming out more. Okay, what Krish is doing is he's zooming out more, and he's saying, okay, instead of using this low, use this low. So Krish is not wrong. The only difference between what I'm saying and what Krish is saying is, I have artificially forced you guys to zoom into this level. That's why I'm picking this answer. Okay, is this clear? Krish, you're clear, right?
Yes, sir.
Okay, so now let's go back to the logic. So make sure that, because I'm seeing that people are still not clear about, I can see that people are still not clear about the logic. What is the basic, where did we write this down? That we had a general principle for selection of stops. Okay, so there is a point where I think it's written either in DP4 or, anyway, I'll write this down later on. Basically, it's just same. I'll find the, it's in different parts of your notes. I think it's in the 6.2 solution. Yeah, this is where it is. We are discussing 6.2. It's in the separate notes, okay? Which is, you have to always remember that, and this is nothing, you don't have to memorize this. This is a basic, this is common sense, right? We will just do this logic once again. It's the same logic. The basic principles are the same for selecting stops for momentum traders, long and short positions. We are taking 4 decisions here, okay? We are selecting 4 types of stops in 4 different scenarios. Momentum trader, long and short, mean reversion trader, long and short, okay? The 4 different scenarios. We are showing you where the stop will be, but the logic is the same everywhere, okay? So look, let's put this here. What is the general principle? If I take an action based on an assumption, okay, and then we find that the assumption is invalid, then we should reverse the action taken on that assumption, okay? We can make it even clearer. Very simple. I don't even have to, I'm writing it because we have to write the theoretical principles in a very clear and comprehensive manner. But this is common sense, okay? If I do something based on some assumption and I find out later on that, like if somebody tells me that I'm leaving the house, somebody tells me there's going to be rain, so I pick up my umbrella, although it's a big heavy umbrella. And then as I'm going out, again, I get new information that it's not going to rain. Then obviously I'm not going to carry that big heavy umbrella. Okay, so I'm going to leave the umbrella at home because now I have new information that it's not going to rain. So that's basically what it is, general principle. Okay, so that's all we need to solve this problem. Okay, let's go through this logic now. So let's take this for a simple long position. Okay, mean reversion trader long position. Okay, or we just take a long position. Okay, let's take a long position example. That's what we are discussing right now. In the case of GE, right, long position. Long position, implied trend view is bullish. Everybody understands. I'm going to write some stuff and I'm going to go stepwise through the logic. Your duty is to pay attention. Anytime you don't understand anything, you have to ask. Otherwise, you're the one who's going to get into trouble. I see them going long. I see Sachin and Mithali going long. The 6.7 here, entry price. Okay, so immediately I don't have to ask them what their trend view is. Their trend view has to be bullish. Otherwise, they would not be going long. Okay. Trend view bullish, okay, which can imply, now we are going to make it more specific, uptrend. Okay, so all we are saying, instead of saying just that prices are going to go up, we're going to make a more specific statement and say that they believe that a new uptrend, because so far it was a downtrend. So Sachin and Mithali believe that now a new uptrend has begun. That's why they went long. Okay, so prices will go up. Yes, let's make it more specific. They are talking about an uptrend. They see an uptrend happening. That's why they went long. Okay. Up to here, everybody's clear. Okay. What is uptrend?
Sir,
Yes, Vipul.
Sir, can you show the graph again, sir?
Your audio is muffled. Your audio is muffled.
In the explanation. Sir, am I audible now?
Yes, yes.
Hello?
Yes, yes, you are.
Sir, can you show the graph?
1 minute. Let me just write this first and then I'll explain. Yes, Vipul, come again with your question.
Sir, can you show the graph again, sir?
Yeah. Yeah.
Sir, I just want to confirm one thing, whether I am right or wrong. Sir, can we say that in the explanation part that the lowest low is 5.89, and if it breaks, then only the new low will be made. So we will choose it as a stop point for the stock.
Okay, you're correct. You have not given a complete answer, but the last part of your answer is correct. Okay, that's now you've got the correct principle. So I'm just explaining that. Okay, so just
Okay, sir.
once you see the full explanation, because I have to make sure that everybody has understood and everybody has understood all the steps. Okay, because even in your answer, you have not given all the steps. You have to get used to answering as if you're talking to a computer. So you have to explain everything.
That's why, sir, I asked this question.
Yeah. Your answer is correct. Last part of your answer is correct. Now see the full answer. Okay. So long position implied trend view is bullish, which means uptrend. Uptrend. What does uptrend mean? Higher highs and higher lows. Okay. I put highs and lows in brackets. So you read this: higher highs and higher lows. Okay. Now. So what I'm writing is remember that for remaining in a position, it is required, if you are in a long position, it is required that the uptrend remain intact. If you are in a short position, the downtrend has to remain intact. Okay, that is true in every case. So now what happens is they're in a long position, they're uptrend, they're betting on an uptrend. And so you have to ask yourself, at which point will uptrend be neutralized? Okay, it's no longer intact. At which point is the uptrend no longer intact? So, okay, now what has happened here? When these guys go long, they're saying there's going to be an uptrend. Uptrend from which point? From the lowest point that was made by the downtrend. Obviously, that's because they are a mean reversion player. So they're talking about a turnaround. Okay, contrarian. Remember the other term for mean reversion is contrarian. That means contrary. So Vipul says buy, I take a contrary view and I say sell. So I'm a contrarian comes from contrary. So they see the current trend and they go contrary to the current trend. They want to buy. So if these guys finally end up buying, they're saying, okay, now that means that they're saying now there's going to be an uptrend. Uptrend from which point? Uptrend obviously from the lowest point marked by the downtrend, by the previous downtrend. Is everyone following this? Okay, that's why you notice that both Krish and Sachin used this language. The lowest point marked by the downtrend, something like this they were using, and which Vipul also has used just now. Okay, so that is the key point to focus on. If these guys are saying there's now an uptrend, uptrend from which point? From here, from here, from here? No, from here. Because this was the lowest point. You notice these guys did not go long until right up till here. Okay, because all the while there was a downtrend. So now the downtrend has reversed. Now there is a new uptrend, is what Sachin and Mitali are telling us. Okay, and that's why they went that's why they went long here. So now, what is the point at which if they're saying there's going to be a new uptrend, there has to be we need to see higher highs, higher lows, and this will be the first low, and there will be a high here, and there should be, and this is coming down, but there should be a higher low. In order for it to maintain an uptrend, there should be a higher low at this point somewhere. Okay, which means that, what does this mean? that the new low, whatever low is being made here after the low, first low and the first high, the second low, okay, after the first low and the first high is made in the new uptrend, in order to maintain an uptrend, you can't have the second low going lower than the first low, okay? That's why you select the lowest point of the previous trend, whether up or down, okay? So you select this because once the market goes below this, the 593, that's why Sachin's stop was at 592. At 592, this low from which they thought that a new uptrend was beginning, that has also been destroyed. So you can't even have higher lows. Okay, so the uptrend is destroyed. So their whole set of assumptions on which they went long, thinking that there was a new uptrend, that assumption is destroyed. So what is the general principle? The general principle is you do something based on certain assumptions, okay? And the assumption is now invalidated. And so now you should undo what you did, okay? So that's why, what did they do? They went long based on an assumption that there's a new uptrend from here. And as soon as the price breaks below this, the assumption of a new uptrend from here is totally destroyed. So therefore, they must undo the action that they took based on that assumption, which is when long here, 100 shares. So here you have to sell 100 shares. So you should have a stop at 592 for 100 shares. Is everyone clear up to now? This is basically going to be the lowest point in general terms. If you state it, this is going to be the lowest point of the previous trend. Okay, the extreme point of the previous trend. Should not say lowest, because then we can't use it for uptrends and reversal of uptrends. Here, this is the lowest. In the case of an uptrend, it will be the highest. Okay, so this is the point where the stop needs to be. All right. Okay, is everyone clear? Vipul, you have another question?
No, sir, it's clear, sir. So we have to say that this is the extreme point of the previous trend, and
Correct.
From this point, the new high trend, new uptrend is forming. And sir, ऐसे मतलब in this way, sir, we have to explain.
Correct. So the new uptrend is forming. That's what you think. That's what Sachin and Mitali think is happening once this neutralization happened. So therefore, they go long. Yes, that's fine. But they have to place a stop at this point because,
Yes, sir.
because if now the market, after having broken this, if the market now goes below this again, that means this whole hypothesis that they had, that there is a new uptrend forming from here, that is totally destroyed. So they have to exit their position at this point. This is how you set the stop. Okay?
Okay, sir.
Okay. Back once again, I'll just give you a rundown of this once again. Go back to our earlier discussion on Procter & Gamble. We discussed Procter & Gamble. We saw this uptrend into which we wanted to go short but did not get a sell signal all the way until here, 4th of September, when this low was broken. Okay. So if I went short here, once again, I'm repeating the logic so you can understand it. When I went short here, what am I saying as a mean reversion trader? I'm saying, oh, this long uptrend is now over. Now we are going down. So if I'm going down, first statement is prices are now going to go down. Let's make it more specific. That means we are now going to be in a downtrend. And downtrend means, new downtrend from where? From the extreme point of the previous trend, which is, in this case, is an uptrend, which is the highest high of the uptrend.
It's a 141.75.
Yeah. Okay, so that means if I'm going short on a break here, now I expect prices to fall. Let's make that statement more specific. I expect there to be a downtrend. A downtrend means lower highs and lower lows. So therefore, there can absolutely not be, if I'm right, there cannot be a high higher than this, because this is the point from which I'm expecting a new downtrend, which means this is the first high, first low, second high, and this low. If you zoom in now, just to see the PNG price action in detail, you can see that the second low is lower than the first low. Okay, so this is the second condition that Vipul was talking about when we discussed this. Okay, so now what happens? I see the first break, the first sell signal, I go short. which means the new downtrend should be happening from here. Okay, so the second low which formed, the second high which formed after the first high and the second low, and the first high and the first low, the second high cannot go higher than the first high in the case of this kind of a downtrend situation. So this cannot go here because you need to maintain the pattern of lower highs, lower lows in a downtrend. That's why when I go short here on the break of this important support, when I go short, where is my stop? It's going to be here.
141.75.
This is going to be here. Yeah, you can see here 141. If you read the cursor, it's 141.67. But what is more important actually is to visually understand where it is. Okay, that's what is more important. And to understand the logic. The logic is more important because now I'm saying there's a new downtrend. A new downtrend from where? Obviously from the highest point of the previous uptrend. Okay, so therefore, under no circumstances can we see a price higher than this high, because then my theory of a new downtrend is totally gone. Is this clear? Everyone has understood logic of stops?
Yes, sir.
Okay. Okay. So now we are doing this one. Now, once you do the long position, short position is easy. Let's look at LVS. Okay. We are still doing momentum. If we want to lose some money, we can look at a casino company. Okay, let's do 3 months. Okay. In this case, LVS, you can check and see that the 1 year is also down. The trend is down. Okay. So 3 months, I look at it. There is still an uptrend. There is an uptrend, but it's been neutralized. Okay. So you saw on the 3 month, actually, there is an uptrend from here, but there is a neutralization of the uptrend. Okay. So as you were watching this trend, we can maybe zoom in a little bit. Yeah. As you were watching this uptrend happening, you did not believe in it as a mean reversion trader. You wanted to go short, but you could not because there was no neutralization. This is the first point where there's a neutralization. We've already discussed a short stop placement through PNG just now, but I'm doing it once again for one of your tickers, LVS, where you see this is the point from which the highest low from which a new high is made. Okay, and this is the point which maintains the uptrend. So as soon as this point breaks, the pattern of higher lows, which is required to maintain an uptrend, is broken. Okay, so the uptrend is neutralized, and now boom, you can go short here. Okay, so if you were here, you would have a sell stop entry target. You would have a sell stop entry order. Actually, you would be entering with a stop order just below this. Okay, so you would go short here. Okay, as soon as you go short here, now what we are discussing is stops at this point. Once you go short here, your stop has to be here, because once again, you're going short. That means you expect prices to fall. That means you expect a downtrend. A downtrend means lower highs, lower lows. And downtrend from where? Obviously, new downtrend. Talking about a new downtrend has to start from the end of the previous uptrend, which is here. So cannot have any price going above this. But this is the start of a new downtrend. So if you go above this, then you don't have lower highs. So the second high, after the first high and the first low, the second high cannot go above the first high in order to maintain a downtrend. So therefore, the stop has to be here. When you go short LVS here, okay, you put a stop here. Now, when you've gone short, now this will be a buy stop. There will be a buy stop over here. Okay, whatever this point is. You're not going to waste time reading it off the cursor, but visually, I think you know what I'm referring to. Everybody understands what I'm referring to. Okay, so we have covered this now. All right, that we have LVS. So I've given you another. Okay, Apple is not as part of your stock, part of your, to help you solve these problems. Okay, here. So Apple is another case, is a different kind of case where you're looking at a very long uptrend. So here's how you might use mean reversion. You're a long uptrend, but you see a fairly big correction. You follow the correction, downtrend going on. Okay, Then zoom in a little bit more. If you look at this high, this high, this high, this high, this is where you go long at this point. At this point, if you are a mean reversion trader, just focusing on this. See, if you're a mean reversion trader, you're looking at the downtrend here and you are not convinced that this is going down. You think that any time now it will turn around and move up. So what do? You wait for a break of this. That's,
Sir?
yes.
Sir, but in this case, the uptrend is not neutralized at any point, sir, because the highest extreme of the previous trend is sir, at something around, sir, 138.
Yeah, you're right. You're right. I'm just giving an example actually. So,
okay, sir.
No, see, because the way it works is, see, basically the way it works is, you look at your trading time frame first. Let's make it shorter. Your trading time frame, let's say assume that your trading time frame is 1 month. When you look at your trading time frame of 1 month, you look at Apple, you see a downtrend. But because you're a mean reversion trader, you are not convinced about the downtrend. You want to go against the downtrend. You want to go up. You want to go long. Are you following? Okay. Now, let's say your long-term time frame is 1 year. Okay, I'm kind of by force creating examples because I want to show you some situations where and how your decision rule is set. Okay. So, but I'm showing you a situation where your trading time frame is 1 month. Okay, and your long-term is up, but you see a downtrend in the trading time frame, but you're not convinced about the downtrend because you're a mean reversion trader. Are you following, Vipul?
Yes, sir. Yes, sir.
So you're not convinced about it, but at the same time, you can't go long. I mean, you really want to go long, okay? Your heart wants to go long, but there is no signal yet. The signal to go long comes only when this is broken. Because the downtrend high, 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 low, 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 low. Downtrend is still being maintained. It is still intact. So
yes,
it may go lower. At this point of time, if you are a mean reversion trader, your heart is set on going long, but you don't have the signal. The signal comes on a break of this. So when you go for a coffee, you can place a buy stop at this point. The buy stop in this case is not an exit order, it's an entry order. Okay, this we will discuss more in DP5. But when you go for coffee, you don't want to miss out. If the market suddenly shoots up to 136, you don't want to miss out. So you place a buy stop order. You have zero position right now, okay? You have zero position. But you want to enter as soon as the market, what's your thinking? Your thinking is as soon as the market goes above this, I want to go long. How do you make that happen? Either you can watch it all the time, but you can't watch it all the time. So when you go for coffee.
Maybe, sir, I can set a bid.
No, not bid. Be careful about the terms. When you go for coffee, 1 minute. When you go for coffee, remember you have no position right now. Your heart is aching, you want to go long, but you have no signal. When will the signal come? When the price goes above this. So what do you do when you go for coffee? You have no position. It's a buy stop. Place a buy stop above this high. Okay. You read it off, you place a buy stop above this high. So what does that do? As soon as the market breaks this high, it puts you into a long position. Okay. And once you go into a long position, then you have to put your, if that happens immediately from here, then your stop will be here. Because now you've gone long, that means you think that this downtrend is over at this point, the lowest point of the downtrend, the extreme price of the previous trend. Okay. So the previous trend was a downtrend. The lowest point of the downtrend was here. So after you have gone long here with the buy stop, okay, and then once you go for coffee, the market goes above this, then you get the stop order executed. You come back from coffee and you find that you're long at 121. Okay. Now where will you put your stop? The answer is here. Is everyone?
So the lowest low 102.49.
Yeah, whatever the low is, I'm just showing you visually where this is. Once you know visually which point to look at, then you can read off the actual value from the cursor. That we are not doing right now. But I want to make sure visually you know where to go.
Yes, sir. Now it is clear, sir.
Everyone clear about this? What we just did? Okay, maybe we are approaching the lunch hour, so everybody's getting sleepy. So we have 2 more minutes. We'll try to just figure out where we are, or I can let you go a little early today because I've taken 2 minutes extra earlier. We have covered a particular point, right? So what have we covered? I'll just quickly wrap up and then I'll let you go. Okay, so where we are is,
Sir?
yes.
Yeah. Yesterday I sent you a certain pic regarding a certain doubt.
Yeah. So that you ask after the class.
Yes,
Okay?
sir. Sure.
So I'll just wrap up here where we are. Okay, so we have done this. We are constructing a simple trading system, which is initially a very bare bones system. The first 3 DPs I have already solved for you. So that means we have, in the bare bones system, we have only 3 more DPs to solve. This we have discussed. Number 4, we have now completed the discussion of number 6.2 also. Okay. And number 5, we are always solving with market orders for the moment in the bare bones system. And in the next class, we will continue with the discussion of position sizing. Okay, which is, we'll go on to DP7. So right now we have come to, we have completed. So that is your next point for discussion here in the trading point notes. All right. Okay, guys. So I think today we can give you a little.
Position size is related to quantity.
Position size is related to quantity, correct. So position size means number of units. This discussion which we had, which is basically this discussion with, I'll let you go just now. I mean, I'm just answering the question that you asked. Okay. Position size means we are talking about, number of units. That once you have decided if you look at our discussion, entry happens above this, stop is over here. But then the question is, how many shares should I buy when I put the stop buy stop order? It should it be for 100 shares, 500 shares, 1,000 shares? How many shares? How many units? Okay. In general terms, we want to talk about number of units because then we can transfer that discussion to currencies, commodities. We don't want to talk on the number of shares. Okay. So that question which we decided here, we already discussed it, but we will now formalize some mathematical rules, put in some formulae, etc. Use a little bit of algebra. So we'll come to our. Okay, guys. So you can go now, and those who have questions can stay back. The class is dismissed. Yes, Shaurya, your question.
Yes, sir. My main question was that since the price of a certain stock was like 49.40, but it's later become 45.8. It decreased and increased due to decreased later, but it was still showing profit.
Yeah, okay, I understand your point. Okay, just one point, guys, just a technical point. When you send me these kinds of problems or discussion, try to use email because it's very difficult for me to open it on WhatsApp or all. It's much easier on email I can open on a big screen. So try to use email, not WhatsApp. Okay. So anyway, I think, Shaurya, I'm not sure exactly about your question, but I think what I understand is that I think what you're saying is that you went long something. Let's say you went long Apple at 120, okay, and now the market is 112. Maybe you did several, okay, and the market is 112, and it is still showing a profit. But
yes, sir.
You are lost because your entry price. Yeah. So is that what you're saying?
Yes, sir.
Okay. So just check this now. We had a similar discussion with Mukul. If you remember when we had referred it, actually there is a note in your session board, in your calc file. There is a note about discussion with Mukul. There's a session with Mukul where he had called about certain problems. So generally when students call, I put them into a Zoom session so that, I can show them, I can share my screen. It's easier to have a discussion rather than using the phone. So in this discussion, it was mentioned here. Okay, if you see here, I think I mentioned it here. So what these guys are doing, what IB is doing is actually they are doing daily P&L. So you can check whether this solves your problem. You can because I don't have the exact details on when you went long, etc. But what might have happened, let's put it this way, Shaurya.
Yes,
Say
sir.
day one. This is day one. You go
Yes,
long
sir.
at 120, you go long on day one. Okay. Now day two is the price on day two is 104. Okay.
Yes, sir.
And the price on day three is 112. Okay. So we have these 3 days we are discussing. Okay. So on day two, they will show the loss of $16 because you went long at 120 and the day two closing price is um, let's say two prices 104, so 120 minus 104, so they will show a lot of dollars. This is clear.
Yes, sir.
Now on day three goes to 112, so on day three they will show you a loss of they will show you a profit of $8.
Yes, sir.
But what you think, there is a loss of $8 because it's 120 minus 112. Okay.
Yes, sir.
But instead of showing a loss of $8, they're showing a profit of $8. That's because they will take the profit and the loss from the previous day.
Okay, okay, okay.
So what you can do is maybe, so this is essentially what we discussed with Mukul as well. But anyway, what you can do is you can check now that you know this information, okay? Now that you know this information, you can go back and check your exact account details and see whether this understanding resolves your dilemma or your doubt or your confusion.
Okay, sir.
Sir, it might also be the case that he first went short and booked some profits.
Okay.
And when he reversed his trade, he accidentally brought more shares while while selling that short trade which he did. For example, he could have gone for 400 short shares.
I understood, but in that case, Utsav, we should technically treat that as if he had got short 500 shares at 120, and then he bought back 700 shares.
Yes, sir.
So that should be treated as two trades. That is buying back 500 shares at 104 and going long 200 shares at 104.
Yes, sir. So in that case also that will show profit, no? If the trend has reversed in his favor again, the shares have started to go up again.
Yeah.
So that might also show a profit then, despite the prices being low.
Yeah, that will also show a profit. But I thought that initially the situation that Shaurya was describing did not involve this kind of a situation. I thought it was just a simple situation of going long, and he had not squared anything. He was just holding the initial long position. So, but you're right that that will be, but in those situations we should treat it as two different trades. Okay.
Okay, sir.
If you remember the case that we did in lab called Akash Jamal versus Mullah Dawood.
Yes, sir. Yes, sir. There were two different trades happening. Yes, sir. I remember that.
Conceptually, there were two different trades because the person the non-breaching party,
yes, sir.
party in the case of a stock purchase contract, the non-breaching party decided to hold on to the shares despite even after learning about the breach.
Yes, sir.
That was treated as actually that he was a seller, that he had sold, that he bought back the price, he was actually a buyer, that it was assumed that he had sold those shares at the market price when he heard about the breach, and then bought back the same amount of shares once again. That was treated as a new position. Okay, so
yes, sir. Yes, sir.
that is what we are reminding you of, that concept, so that you remember the old concepts as well. Yeah. Okay. Anything else? Any other question?
No, sir.
Okay.
So basically, it is showing profit from the previous day position, right?
Correct. Profit and loss, same.
Okay.
Everything, whatever they're showing you is from the previous closing.
Okay.
Okay. They have a reset for their system. I think around the time that New Zealand opens, they reset their system. So the exact time is somewhere around the New York close. That's how you treat it essentially. If you're not curious about the exact actual time, it's somewhere around the New York close, which is approximately when New Zealand opens.
Okay, sir.
All right. Okay. All right.
Thank you.
Okay. So no more questions. Then you guys can go and enjoy your lunch, and I will stop the recording.